Most traders are flying blind. They have strategies, they have indicators, they even have systems, but they don't have the one thing that separates the amateurs from the professionals. They don't have a trading plan. And here's the thing, your trading plan is not your strategy. Your strategy is what you do. Your plan is who you become. By the end of this video, you'll walk away with the complete framework to build a trading plan that actually works. Not just on paper, but in the psychological warfare of the real live markets. Here's a brutal statistic for you. 95% of traders lose all their money in the first year of trading. But here's what's interesting. It's not because they don't know how to analyze charts. It's not because they can't identify the support or resistance or the supply or the demand. It's because they're trying to trade without a trade plan. And I don't mean a strategy. I mean a comprehensive system of who they become when they sit down at the charts. Think about it. You wouldn't start a business without a business plan. You wouldn't build a house without blueprints. But somehow people think that they can take money from the smartest and most well-capitalized people in the world without a trading plan. That's not trading, guys. That's gambling with extra steps. After spending 5 years in the markets and paying more tuitions to the market than I care to admit, here's what I learned. Your trading plan is the operating system. Everything else is just software. A trading plan has 6 main components. Not 5, not 7, 6. And here's why most people get this wrong. They focus on all the tactical stuff. Entry signals, exit rules, position sizing. That's important, but that's not where you start. You start with psychology, you start with identity. You start with who you're becoming as a trader. Because here's the thing, the market doesn't care about your strategy if you don't have the character to execute it consistently. So let's build this the right way from the foundation. Component 1, define your trading identity and your goals, but not the way you think. Most people set goals like, I want to make $10,000 a month. That's not a goal, that's a fantasy. A real trading goal is process orientated, not dollar orientated. Here's what I mean. Instead of I want to make money, try this. I want to execute 20 trades with perfect rule adherence and journal every decision. Instead of I want to be profitable, try this. I want to build the psychological capacity to take calculated risks without emotional interference. You see the difference? One is outcome focused, the other is identity focused. Your identity drives your behavior and your behavior drives the results. So who are you becoming? Are you becoming someone who trades with discipline? Someone who manages risks systematically? Someone who learns from every trade regardless of the outcome? Write that down because that's your North Star. Component 2 is market selection and specialization. Here's another place where amateurs sabotage themselves. They try to trade everything under the sun. Crypto, Forex, stocks, commodities. They think they're Renaissance traders. But here's what professionals do different. They specialize. They become experts in 1 or 2 markets. They understand the personality of those markets better than anyone. Myself, I only trade gold. My full focus is gold. I know everything that's going on with gold at any day of the week, and I specialize in it. If you're just starting out, pick one market, one asset. Maybe it's Euro USD, maybe it's SPY, maybe it's Bitcoin. Pick one and become obsessed with understanding its behavior. How does it move during different sessions? What economic events affect it? What is the average daily range? Where are the key technical levels? Most traders spend their time looking for new opportunities. Professional traders spend their time understanding the opportunities they already have access to. Component 3, and likely your most important component, is your risk management system. Let me be clear about something. Risk management is not what you do after you have a strategy. Risk management is the strategy. Here are some non-negotiable rules. Rule 1, never risk more than 1 to 2% of your account balance on a single trade, ever. I don't care if you're 200% confident. I don't care if it's the setup of the year. 1 to 2% maximum. Rule 2, always use a stop loss. No exceptions. A stop loss is not a suggestion. It's not a guideline. It's the hard boundary between calculated risk and total account destruction. Rule 3, position sizing based on risk, not on confidence. Your position sizing should be determined by how much you're willing to lose, not by how much you're gonna make if the trade goes to target. Rule 4, have a daily and a weekly loss limit. Let's say you're risking 1%. If you hit 3% losses in one day, you stop trading. If you hit 6% losses in a week, you take a break from trading that week, you review your trading journal, you reassess, you come back next week with a fresh mind. These aren't suggestions. These are the rules that'll keep you alive long enough to develop actual skill. Component 4, entry and exit criteria. This is where most people think their trading plan starts. But notice, we're already 4 components deep. Your entry and exit rules need to be clear so that even a 12-year-old could execute them. Here's an example of a bad entry rule. Buy when no momentum looks good and the RSI is oversold. Here's an example of a good entry rule. Enter long when price is above the 200 EMA on the daily chart. RSI drops below 30, but then crosses back above 30. Price forms a bullish reversal pattern at a key support. See the difference? One leaves room for interpretation, the other is completely mechanical. And here's the key. Your exit rules are more important than your entry rules. You need 3 types of exits. Profit target, where will you take your gains? A stop loss, what's the max you're willing to lose? And a time stop. How long are you willing to hold where price is doing nothing and it's just time to exit out of the trade? Write these down, make it specific, remove all ambiguity. Component 5 is trading routine and psychology. This is where good traders become great traders. Your pre-market routine should be as consistent as a surgeon's pre-operating routine. Here's what mine looks like. Step 1, check the economic calendar. What news are coming out? What times? I personally use Market Edge AI. I'll leave the details down in the description for those that want to excel in their fundamental knowledge. Step 2, review the key levels on my chart, the ranges, and the liquidity levels. Step 3, journal check. What did I learn from my previous trades this week? Step 4, mental assessment. Am I emotional? Do I have a revenge trading mindset? Am I overconfident? If I'm not in the right mental state, I don't trade, period. No exceptions. Your post-market routine is equally as important. Step 1, journal every trade, entry reason, exit reason, what I felt, what I learned. Step 2, review the day. What went well? What would I do differently? Step 3, plan for tomorrow. What am I watching for? This isn't optional. This is how you develop from unconsciously incompetent to consciously competent. And here's the thing about psychology. The market will test you. It will find your weaknesses and it'll exploit them. That's why your plan needs to include what you'll do when you're losing, when you're winning, or when you're bored. Because all 3 of these states will try to deviate you from your plan. Component 6, review and evolve your system. Your plan isn't static. It's a living document that evolves as you grow. Every month, you need to review performance metrics, not just your wins and losses, but your rule adherence, emotional state tracking, and setup success rates. Process improvements. What rules are not working? What new patterns are you seeing? What psychological triggers need addressing? Market adaptation. Markets change. What was working in trending markets will not work in ranging markets. Your plan needs to adapt. Here's what most people get wrong. They change their plan after one bad day. That's not evolution, that's panic. You change your plan based on statistical evidence over meaningful sample sizes. Not emotions, not hunches, data. This is how you go from someone that trades to being a trader. So here's your challenge. I want you to stop this video right now and spend the next hour creating your trading plan. Don't overthink it. Don't make it perfect. Just complete it. Write down your trading identity and your process-oriented goals, your market specialization choice, your risk management rules, your specific entry and exit criteria, your daily routine, and your monthly review process. Then, and this is the most important part, follow it for at least 30 trades before you switch anything. Don't change it because you had a bad day. Don't abandon it because you've seen a YouTube video with a new strategy. Follow it, journal it, learn from it. Because here's the truth, nobody's first trading plan is perfect, but having an imperfect plan that you follow is better than having no plan at all. If you found value in this framework, I'm building something special for traders who think systematically about their development. It's not a get-rich-quick scheme. It's a community for serious traders focused on building sustainable systems and psychological discipline. If that sounds like it's what you need, join our Discord from the link below. And if this video helped you understand the difference between having a strategy and having a plan, hit that subscribe button, because we're just getting started to the systematic approach to trading development. The difference between professionals and amateur traders isn't talent, it's systems. It's preparation, it's having a plan, and the character to execute that plan. Now go build yours.